This is Nightly Business Report with Tyler Matheson and Sue Herrera.
The charging bulls. Stocks have had their longest streak of closing records in 20 years as the major averages keep on climbing.
Speedy delivery. It's an area dominated by FedEx and UPS. But if Amazon has its way, that may be about to change.
Buying a home with no money of your own? A new company wants to help you clear the biggest hurdle to home ownership. Those stories and more tonight on Nightly Business Report for Thursday, October 5th.
Good evening, everyone, and welcome. It was an historic day for investors. The S&P 500, one of the broadest, most widely followed measures of the stock market, closed at a record again for the sixth straight day, making it the longest streak of record closes in 20 years. That, of course, no small feat. Investors are optimistic about broad economic growth, both here and abroad. They are encouraged by corporate earnings, and the prospect of U.S. tax reform hasn't hurt either. Today, the Dow Jones Industrial Average rallied 113 points to 22,775. The Nasdaq added 50, and that S&P 500 was up 14. Bob Bazzani has more now on Wall Street's record run.
The record rally rolls on. The S&P 500 closed higher for an eighth straight day. It makes it not only the index's longest win streak in more than 4 years, it's the longest string of record closes in 20 years. We're seeing record highs right across the board, everything from small caps to mid caps to large caps like the S&P. The markets ticked higher this morning on news that the House voted to approve the Republicans' latest push for a $4 trillion budget resolution, and that it will now go to the Senate. That's big because it sets the stage for tax reform. And with tax reform back on the table, banks, material, and energy stocks are all back up. Since the presidential election last November, 5 sectors are up more than 20%. Tech, industrials, and healthcare among them. In one sector, defense stocks outpaced them all. It's up almost 40% since Trump took office. So what's going on? The economy is continuing to grow. We saw proof of that from those blowout numbers in manufacturing and services this week. Earnings are also still on a solid footing, and inflation subdued. The market's going to keep melting up in the absence of any major shock factor. What could throw the markets for a loop? 3 things. North Korea, a more aggressive new Fed chair than the markets would like, and of course, a tax reform bill that fails. But right now, the markets aren't afraid of any of that. For Nightly Business Report, I'm Bob Bazzani at the New York Stock Exchange.
So let's turn now to Hugh Johnson, who has seen his fair share of winning streaks in the market, to talk about the record run in stocks and what we can expect next now that the S&P has reached that 20-year milestone. He is chairman of his own asset management firm, Hugh Johnson Advisors. Good to see you, Hugh. Welcome back.
Thank you very much, Sue. Nice to be with you.
What do you make of this record run? And does it portend to you that perhaps we're in that bubble formation, or maybe not?
Yeah, no, obviously it's a world of superlatives when we look at the financial markets. And I think the real issue right now, for me anyway, is that there's seemingly a disconnect. Yes, the economy is growing, but the stock market is doing much better than the economy would really allow. And I think really, quite frankly, that's because earnings have been so good. Now, the question is this therefore a speculative bubble? And I would have to answer that question that no, it's not a speculative bubble, Sue, because kind of the defining characteristics of a bubble, which include valuation being very extreme. I don't think that's the case. Lots of leverage or borrowing in order to buy stocks. I don't think that's the case. And probably the most puzzling feature of all, Sue, really is the fact that we don't have widespread optimism or euphoria. In fact, it's quite subdued. Everything is quite subdued. Everybody's quite calm. So quite frankly, I don't think this is a bubble. I think this is simply a bull market, but certainly a one with a lot of superlatives attached.
We certainly have been beneficiaries of good fortune here over the past 7, 8, 9, 10 years almost. But bear markets are not dead and gone. What could cause one, Hugh?
You know, that's a great question. And I think that usually when I look back at financial market history, Tyler, I see a couple of things that combine to do that. Most importantly, of course, is that interest rates go up as the Federal Reserve becomes concerned about, a strong economy and particularly rising inflation. Quite frankly, as you know, that interest rates, even though they're starting to rise, are still at levels which we would call, historically fairly low. And usually, often, that's combined with some move towards fiscal restraint, which really means increasing taxes, reducing spending, and we've got anything but that. In fact, prospects are now for tax reductions if they can get that through Congress, as well as spending increases. So you don't have the combination now, but watch out. Watch the Federal Reserve, watch interest rates, and also watch Washington for if they get unnerved by the fact that the deficits are fairly large and they start to reduce spending.
On that note, Hugh, thanks so much for spending time with us. Hugh Johnson with Hugh Johnson Advisors.
Well, as we mentioned at the top of the broadcast, and as Hugh just echoed, the prospect of tax reform, lower taxes, is one of the issues lifting the market. As Bob Pisani reported, the House today passed a $4 trillion budget bill, initiating a process that Republicans hope will result in the enactment of tax reform later this year. A Senate panel today voted to send a budget measure to the Senate floor for a full vote, and when that happens, it formally starts the process of so-called reconciliation, during which lawmakers could pass a sweeping tax reform bill with a simple majority of 51 votes in the Senate instead of the usual 60-vote requirement.
The White House has asked Congress for $29 billion in additional hurricane relief. The request comes about a month after lawmakers approved a first installment of $15 billion in aid. Billions more will likely be requested as Puerto Rico assesses the damage from Hurricane Maria. The funding also includes more than $570 million to address wildfires that have been rampant recently in western states.
Well, speaking of rising interest rates, the president of the Philadelphia Fed has penciled in an interest rate hike for later this year. That view comes despite a tepid outlook for economic growth, which he says will remain around 2% unless lawmakers come up with a tax plan to boost the economy. But Patrick Harker also pointed to another issue that he says is holding back growth.
One of the limiting factors, I would argue probably the limiting factor right now in growth in the economy, is not access to capital, although for small businesses that's an issue. It's the inability to get the skilled workers. This mismatch between what companies need and what workers know is real and growing.
President Harker added that workforce development should not be viewed as a social service, but as an economic investment.
And sticking with the job market, the number of Americans filing for unemployment benefits fell more than expected last week. Initial jobless claims dropped 12,000 to a seasonally adjusted 260,000, though some of that data is muddied by Hurricanes Harvey and Irma. The hurricane impact is expected to show up in tomorrow's monthly government release. Economists expect non-farm payrolls to increase by 80,000. The unemployment rate is expected to stay steady at 4.4%, and average hourly wages are forecast to inch higher.
Companies are planning fewer job cuts. The outplacement firm Challenger Gray and Christmas says the number of potential layoffs is down 27% from last year. But even as employers hold on to existing workers, the report states that many positions requiring skilled labor are going unfilled.
But one sector that is hiring a lot is healthcare. The unemployment rate for the industry is well below the national average, and that's making it harder for hospitals and other firms to fill some jobs. Bertha Coombs has our story.
Bait, some water.
Vivian Butamania left a human resources job last year to become a home health aide for better pay and other rewards.
It's not really like financial gains. To me, it's when you're appreciated by a client as well as, the person who employed you, it's more than anything.
As Americans are living longer, demand for home health care workers is growing, and for home health firms, so is the competition to find them.
We're having to open up our pipeline. We're having to think innovatively. So we're looking at ways to certainly help with not only benefits and pays, but also just to provide even a better experience for our care workers in general.
They're not alone. Hospital unemployment is now just 1.4%. At health centers like Ohio Health in Columbus, they're looking more at incentives like student loan help in order to attract and retain doctors.
I was with one of my recruiters yesterday, and she was working with a hospitalist who had $500,000 worth of student loan debt. That's a a pain point for a lot of physicians coming out, and even physicians that are practicing.
While uncertainty over healthcare regulation in Washington has given some health executives pause, hospital hiring has slowed in recent months, partly because of a shortage of workers, especially when it comes to doctors and nurses. It now takes a record 49 days to fill a healthcare position, according to DHI Group Consulting, 2 weeks longer than the highly competitive IT sector. So more healthcare employers are trying to train and grow their workforce.
The most innovative are the ones that are adding to their portfolios and really going out and having an ongoing dialogue in the community, pipelining people, understanding who's in the market.
Courting them early.
We are recruiting right now several urologists that are not going to be available until September of 2019, but we're actively working with them.
And hoping that, like Vivian, they'll feel that connection to their team. Bertha Coombs, Nightly Business Report.
Still ahead, get on board. Would you fly in an electric plane? How about one without a pilot? The future of air travel is changing quickly.
One of the nation's largest health insurers will stop covering a main opioid painkiller. Starting next year, Cigna will no longer cover OxyContin, the branded version of oxycodone. Cigna has pledged to cut opioid use among customers by 25% by 2019.
For many years, FedEx and UPS ruled the delivery business. But Amazon is now trying to change that. Now, we've already reported that Amazon is building a hub for its own cargo airline, and there are now reports that the company is even venturing into the ocean freight business. Now it's reportedly testing a new program that can more quickly deliver an additional number of items sold on Amazon's website. Morgan Brennan has more now on Amazon's latest push into the territory of FedEx and UPS.
Amazon is diving deeper into the delivery business. The e-commerce giant is reportedly testing a new service in the U.S. that would target independent sellers who participate in Amazon's Prime 2-day shipping program. Amazon would manage package delivery even as those shipments potentially bypass its own vast network of warehouses. UPS and FedEx would still likely make deliveries for those customers, but by bringing the logistics in-house, Amazon would likely be calling the shots. But analysts say investors are missing the bigger picture.
Amazon is just doing what large retailers do. They build out their own infrastructure. I mean, look at Walmart. Walmart's got almost 8,000 trucks, 30,000 trailers, dozens and dozens of distribution centers, and yet they're still the largest customer for every major trucker out there.
For UPS and FedEx, e-commerce, while growing dramatically, still represents less than a fifth of overall business, with Amazon a fraction of that. It's a dynamic FedEx founder and CEO Fred Smith discussed just last week.
Amazon and Alibaba are retailers. We pick up, transport, and deliver things from 220 countries in the world, from billions of peoples and hundreds of, millions of businesses, one to the other. So they seem like they're the same when you get your package, but what's going on upstream is remarkably different.
In response to today's report, FedEx adding that there seems to be a, quote, clear misunderstanding of the scale, infrastructure, and complexity involved in running a global transportation network. And UPS saying, quote, we support all our customers with industry-leading solutions and expect to expand these relationships in the future. As for Amazon, the company states it's using the same carrier partners to offer this program that it's used for years, including UPS, the U.S. Postal Service, and FedEx. All of which is to say, bringing more management of Prime offerings in-house is the next logical step, one that helps Amazon better manage its shipping costs since it can negotiate lower rates and better plan for surges in demand, especially since each holiday season delivers a new shipping record. For Nightly Business Report, I'm Morgan Brennan.
General Motors has more than doubled its self-driving car fleet in California. The company is testing vehicles in San Francisco as part of an effort to develop software capable of navigating congested big city streets. The automaker also reported more run-ins between its autonomous vehicles and human-operated ones, but said all of the incidents were caused by the human driver.
Blame it on the other guy.
Yep.
All right, automakers have been testing, obviously, those self-driving cars for some time now, but they're also investing in electric cars. And now the aviation industry is looking to test those technologies in the air. It could lead to a dramatic change in how we travel. Phil LeBeau takes a look now at the future of flight.
This is the Zunum Aero. While this animation shows a plane that looks like other small jets, it's different. The Zunum Aero is a hybrid electric plane.
This aircraft can allow you to bypass the hub system on short regional flights and get you to your destination 2 to 4 times faster than you do today at prices below commercial.
The Zunum Aero seats a dozen people and can fly up to 700 miles, primarily on battery power, meaning 80% lower emissions and noise levels. Zunum's funding comes in part from JetBlue and Boeing. While Boeing's not getting out of building commercial airplanes, it is looking at new technologies that could change how the world flies. For example, it's buying Aurora Flight Sciences, which develops technologies for autonomous aircraft and robotic cockpits. Boeing admits some of this technology may be years from making it into planes, but aerospace is changing quickly. Next year, Airbus plans a first flight for its 4-person air taxis. They could eventually fly without a pilot. Is the public ready to get on board with all of this? After all, flying is still an uncomfortable experience for many people. But the folks at Zunum Aero think travelers will have no issue flying in a hybrid electric plane.
By the time this aircraft is in the air in early 2020, everyone would have ridden in an electric car or ridden in an electric bus. This will be a non-issue.
The future of flight taking off in a new direction. Phil LeBeau, Nightly Business Report, Chicago.
Investors raise a glass to Constellation Brands, and that's where we begin tonight's market focus. The brewer hiked its full-year profit outlook after reporting better-than-expected quarterly results, helped by strong demand and higher beer prices. The owner of Corona and Modelo also said its business accounted for more than 60% of the growth in high-end beer sales in the U.S. during the quarter. Constellation shares rose 4% to $209.25. The International Trade Commission said imports of foreign-made washing machines are hurting domestic manufacturers. The decision comes after Whirlpool filed a petition against Korean competitors Samsung and LG. The commission will soon give its remedy recommendation, which could include increased duties on Samsung and LG. President Trump will make the final decision. Whirlpool shares were off 1% to $183.44. Drug maker Omeros said it had reached a settlement with rival Endo International that delays Endo from marketing a generic version of Omeros eye drug until the year 2032. Shares of Omeros were up 3% to $22.86, while Endo shares fell nearly 2% to $8.66.
Pennsylvania's Attorney General is suing the student loan provider Navient, alleging the company pushed subprime loans to borrowers who they knew were at risk of defaulting on them. The government says one of the programs the company ran cost loan holders $4 billion. Navient said the allegations are unfounded. Navient shares, nonetheless, down 14% to $12.61. And Sears will borrow again from its owner, Eddie Lampert. According to a regulatory filing, the department store chain will borrow $100 million from Lampert's hedge fund ESL Investments. That brings the total Sears has borrowed from Lampert to just under $500 million. Sears shares rose 1% to $7.29. And casino operators Penn National Gaming and Pinnacle Entertainment reportedly considering a merger. The Wall Street Journal says the two companies have not been able to agree on terms of a deal, but that Penn National is still interested in buying Pinnacle. Penn National shares were up about 5% to $24.05. Pinnacle gained more than 8% to $23.70. And after the bell, Costco reported profits and revenue that beat street estimates. The company also saw same-store sales rise at a faster pace than analysts expected. Despite the solid results, though, shares were initially lower in after-hours trading, but they did finish the regular session up 1% at $167.07.
Mortgage rates are holding steady. That's good news for prospective home buyers since they are historically at low levels. According to Freddie Mac, the 30-year fixed rate average is now 3.85%. Many say the short-term economic impact of the hurricanes will keep mortgage rates in a holding pattern since they closely track the 10-year Treasury yield.
Now, ask most young renters today, and they will tell you that while they'd like to own a home, saving for the down payment is harder than ever. High home prices, steep levels of student debt have seen to that. So what if you could get others to help you, like crowdfund your down payment? Diana Olick takes a look at this new way to buy a home with no money down of your own.
Today's young Americans are more social, more willing to share. But will they help each other buy homes? That is the bet one mortgage lender is banking on as it launches the first program allowing potential home buyers to crowdfund their down payments.
This allows you to tell your story. It allows for folks to be able to buy in to the story of what it is you have, your loan story, your home story. And one of the things our tagline is fund your way home.
CMG Financial, a mortgage lender, is launching Home Fund Me. It's an online platform that gives home buyers a way to both market their needs and receive multiple tax-free cash gifts from anyone to finance the down payment on a home. Previously, lenders limited down payment assistance to close family members, employers, nonprofits, and religious organizations, all with significant documentation. This pilot program has the blessing of Fannie Mae and Freddie Mac, which finance the vast majority of mortgages today.
What we're doing today is we're trying to test and learn a variety of solutions because the preferences for today's homebuyers have changed significantly, and there's no silver bullet to solving a problem that's as hard as how do you find a down payment.
Millennials are not only saddled with high levels of student loan debt, they're also paying very high rents, which makes saving harder. But they're also starting to get married and have children.
Of course, we see the wedding registries. You're going to spend $250 on a coffee making machine. If that $250 goes to a down payment of your home, at the very least, I improve your quality of life.
One red flag in the plan is skin in the game. If you're crowdfunding your down payment and then using a mortgage, are you really invested in the home? No down payment loans were blamed for the last housing crisis when home prices plummeted and thousands of borrowers defaulted on their loans and even walked away because they had nothing to lose.
Skin in the game is a little bit of a confusing concept. If you pay for your closing costs, is that skin in the game? Is it really down payment? Would you rather have somebody have a lot of money in the bank after they buy the home and no down payment, or the opposite? And so we still have a lot of questions and a lot to learn when it comes to the role of down payment.
And that's why this is just a test program to see not only if the crowd is willing to fund home buying, but also if homeowners see that gift for all it's worth. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, content is king, but which company will wear the crown?
Netflix will hike prices. The streaming video company now charges $1 more a month for its most popular plans. The price hikes will go into effect today for new subscribers. Current subscribers will soon get an email from Netflix and will see their rates go up next month. Netflix making a big push, as you probably know, into original content, which is not cheap. It is looking to spend about $7 billion on movies and TV shows next year. Wall Street on board with the new prices, sending shares up 5%.
Netflix and other non-traditional media companies are taking on the traditional players in Hollywood. And the question for investors is, who will win the future of video? Julia Borson recently talked to some of the industry's decision makers at the Vanity Fair Summit in Beverly Hills.
With cord cutting on the rise and TV ratings on the decline, Disney is working to go direct to consumer. CEO Bob Iger explaining the company's plan to launch a direct to consumer ESPN app early next year, followed by a Disney app in the second half of 2019.
I think a lot of the dialogue about this, a lot of the debate, a lot of the rhetoric is due to the fact that the business is feeling the pressure of disruption. There's just a lot of change and a lot of uncertainty and a lot of tension that exists between the traditional players in the business or among the traditional players as consumers have more choice, as new distributors come into the market, as new producers come into the market, and I think that's what's going on. But you know, I feel great about where we have ended up.
And HBO's Richard Plepler says the investment in giving consumers digital options is paying off. That, combined with HBO's content, is keeping consumers hooked, despite the explosion of competition from Netflix, Amazon, and others.
We're getting about 25 to 30% of our viewing on different platforms. That's why we built HBO Go originally. HBO Now affords you the opportunity to watch it on your television set, as does HBO Go, or on whatever platform you want. We want our consumers to have options, and we want them to have options that give them flexibility.
Now, as the traditional media giants invest more in digital, we're seeing the tech giants invest more in content, with Facebook funding shows for its new Watch platform and Amazon spending more on shows and sports for its Prime Video subscription service. Amazon streamed its first NFL game Thursday night, spending a reported $50 million for 11 games this season. And in a rare interview, Amazon's SVP who oversees content says they're interested in doing more of their critically acclaimed shows like Transparent, as well as bigger content investments.
We're trying to make these big, broad, shows that all customers around the world, we're in 200 countries now with the service, will want to watch. And we think we have a few of those now, but we'd like to have even more.
Blackburn says Amazon wants the best content like Game of Thrones, and they're willing to pay for it. For Nightly Business Report, I'm Julia Borston in Beverly Hills.
I'm so glad you're back. No more wandering.
A lot of travel lately.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Thanks for me as well. Have a great evening, everybody, and we'll hope to see you right back here, Jobs Day, tomorrow.
Yeah.